Tushar, good morning. Thank you for joining
Morning.
us. Are markets driving you crazy because they refuse to come down irrespective of what is happening on the valuation front, on the demand front, on the Fed front, on the inflation front?
Well, markets are always going to be confusing, Nikunj, and I think by now we know that they know a lot more than all of us put together. So the collective intelligence obviously is a lot better in the market and it disseminates. So what is it that we are missing? I think we should start focusing on that. I was just looking at some data points, and it appears that the last year COVID wave, the impact on the economy, this year's COVID wave, and the impact on the economy. Last year, we had a sudden jolt in the market because we were in uncertain, areas where we didn't know how it was going to actually work out. And if you look at the numbers, we took a fantastic and a very strict lockdown, which stopped all economic activity all of a sudden. And it took time for the economy to restart. But the actual fatalities, the actual impact on the ground was not anywhere compared to what actually we faced this year. And this year, when the second wave started to, really impact us, the markets came off a little bit between 7 to 8% and to probably 10%. But what it quickly understood is that, first of all, the momentum is continuing. You did not have any serious supply disruption this time. We did not stop interstate, travel, transportation, production. We were not, heavy-handed in terms of, stopping production activities. It was localized lockdowns, and generally people found it difficult to move about. But manufacturing essentially continued. Now, on top of what was happening last year and what is happening now, you will see a tremendous change in terms of the momentum of earnings this year. On top of that, if you look around, the kind of pullback we have seen in terms of the April GST numbers tells you where the potential of the economy is if it comes back to normal. I think we are also seeing a little bit of I would say relief in terms of the COVID numbers coming down. And then probably the market is calculating back in terms of if that was just after a very severe lockdown and a start-stop economy, what can happen if the economy has continued throughout this period? The world economy is on very, very sound ground, and estimates of upwards of 6% for global growth and for us 8 to 9% of GDP growth. I think that's a combination of it is. But I will tell you where the problem is and why is it that we find it confusing. Is because our personal economy, for example, when we look around us and the kind of difficulties we have faced, we are not in a good mood. So I think that is where the dissonance is coming. If you just focus on the hard facts, I think maybe what the market is doing is probably rational, trying to price the expected growth coming forward.
This is such a great point, Tushar. All of us have had our own terrible, horrible, and painful experiences. The near and dear ones have really suffered in the second crisis. And then when you look at markets and economy from that mood and point, everything looks dim. But if you look at hard data, and markets are sometimes non-emotion, they do not follow emotion, they look at real data, the real data is very different. So Tushar, what we've done is that we've justified why markets have not fallen. Now let's try and justify that why markets will go higher from here, because markets are working with this template that things will get better, economy will come back. And that explains why Nifty is at an all-time high, Sensex is at an all-time high. But what is the justification for someone to buy from here? Because markets are already pricing in, let's say 2, 3, 4, 5 quarters of earnings.
Yeah, that's another fantastic question, Nikunj. I think a lot of investors are asking this question. Let me put the context in terms of why would you prefer an asset class over the other? It is always going to be an opportunity cost. If you look at where we are in terms of the global interest rates, they are near zero, even if they threaten to go up a little bit in the US in absolute terms, they're nowhere near significant. And also, in addition to that, you have to remember that inflation is rearing its head everywhere over the world, which should tell you that real returns are really negative at this time, which means there is a scramble for yield. Now you look at our stock markets and say, what is my expected return even if valuations are at an all-time high, then obviously future returns are impacted because of your current valuation, right? So if they are significantly higher or maybe 2 standard deviations away from the mean, then what to expect? I think we will expect sub average returns. So for example, the average returns of our market in the last 10 years prior to 2019 has been around 8 to 9%, compounded average for 10 years. The last year made a significant change in the average by going up 60, 70% on an average, depending on whether you take the financial year or the calendar year. And that has improved the compounded average return over the last 10 years rolling now to around 12 to 13%. So that's raised the average. So going forward, should we expect anything higher than average going forward? If I were conservative, if I looked around, I would think that maybe not. But does that mean that that is not a preferred asset class? Yes, it is a preferred asset class, because what am I going to get in anything else? And I think if the earnings continue to sustain, and I think sometimes we need a crisis for an economy to jumpstart. So just go back to pre-COVID. We were really looking at a very significant drop in demand, right? We had a problem in supply. Globally, all sorts of demand was absolutely near zero. Suddenly, demand has come back because of a start-stop. And how long will this demand sustain is how long the legs in the rally will have. So if you think that it will take 2 years for the economy to come back to normal, that itself incorporates pretty robust growth for everyone, including India. And I think that is something which we should not ignore if we say that is this the time to kind of, invest in equity. So invest in equities probably with a rational expectation of return, not something which we traditionally are used to, or not something which is abnormal, probably lower than normal, but then look around the opportunity cost for you. And I think those are even lower. So we have to be ready for a low return world. And within that, given the robustness of the business activity, I think that seems to be a fairly easy choice to make. So that's really where I come from, not really from an absolute return perspective.
One more follow-up question. While once a bull, always a bull. I'm a bull, you're a bull. We're programmed to think that in equity market returns will always be higher. Whether it is double digit or late single digit, we always program to think that equities will give positive returns. What is the risk from this level? Could it be third wave? Could it be Fed? Could it be pure valuations? Could it be inflation? What I'm trying to understand is that you never say never in the market. Returns could be negative from here also. So for that scenario, which is an unpleasant scenario, that you lose money, what could be that factor at play?
Yeah, that's another interesting question, and we keep debating this well into the night every day. And I think I can identify the single most factor for markets to really give way or collapse from here is a unchecked or uncontrolled wave of inflation. And I think, COVID is obviously going to be an uncertain quantity, and we don't know really where we go, whether the third wave is going to come or not. But that is more in the known risk perspective, that we know that there might be variants. We know that we need to have either better vaccines in the future or better treatment or whatever we know. We know about that. But what we don't know is what is this tremendous fiscal boost, especially in the US, the monetary boost that all of the economies have given is going to result in. Is it going to result in large amounts of capital sloshing around, leading to a little bit of a capital cycle? And who knows, maybe an overheated economy leading to very high interest rates and high inflation? I think that's a very, very big risk. If that happens quickly, you're going to see valuations evaporate, because at a higher cost of capital, obviously, the opportunity cost picture shifts, and obviously the returns on equity will not be really that high. So that's a big risk. However, having said that, being a bull, so much so that we are always looking at the positive side, I think the world knows about this risk as well, to a certain extent. It knows how to control inflation as long as it has the tools available in the monetary kit to ensure that they control it in some way. I think the Fed has already sounded a bit of a confident note by saying, look, there's adequate liquidity. We don't want to push more into it. Now we are trying to possibly even take a little bit off the table. So So I think all of those things give me some confidence, but I think this is a big risk. If interest rates really rise, and it happens to be without, because there is a market element and there is a control element. If the spreads actually in the markets continue to rise and people continue to price the risk a lot higher, then we are in for pretty bleak times in the stock market.
Tushar, everyone's been counting on this being, really the next 10 years of India's growth, outstanding growth, despite all the difficulties that the economy has seen over the last year or so. And from what you're saying, we seem set for that as well. In that context, then, where does one look in terms of a strategy for the markets? We've seen a fair amount of rotation. We've seen different points of view in terms of, perhaps where value is to be found right now. But if one was to look at it from a slightly longer term point of view in terms of the real growth opportunity, where would that be according to you?
Well, that's another fantastic question, because typically when we see cycles in an economy, you will kind of gravitate towards the cyclical elements of the economy. So you're talking about manufacturing, commodities, consumer discretionary, cars, trucks, that sort of upwave when an economy turns. And I think that is also going to be there. But I think what is most important to remember is that the next 10 years, especially from an investment perspective, are going to be determined by what happens to the world climate, to climate change essentially. And a lot of capital will be allocated towards assets which clearly in the mind of the investor are going to reverse climate change to a certain extent. Which means our traditional oil dollar economy, which was based on your traditional sense of how the economy moves and what the oil price is and how the dollar in conjunction moves, and especially the commodities. I think that's really where the older economy was. I think the next 10 years are going to be redefined. If you look at the renewable space, and even when you look at India, the amount of electricity generation now moving towards renewables is changing the equation a little bit. So I think going forward, the opportunities clearly will come from areas which feed into the climate change theme and the narrative. And I'll tell you why, because we're talking about very large allocators, including the pension funds or sovereign Nordic funds or whatever they are. They are now very clearly attuned, and they clearly want to invest in the areas of new growth. And this could be, electric vehicles, it could be photovoltaic cells, it could be solar, wind, whatever you talk about. And those are the engines for growth going forward. And I think given that, India is in a very unique position because we do have the skills, we do have the technologies, and we do have the scale for any of these things to actually dramatically improve from here on. So I think while it is not very clear to me exactly which sector and how to point out to those opportunities, I think these are the large, broad things that one has to follow. And if you take banks, for example, if you take financials, the money will follow the opportunity. So I think there is a distinction between trying to kind of identify cycles and trying to run with it. That will also happen, but to a larger extent. And this is really where the market cap increases in the Western markets, especially the US, and how technology-oriented companies now are huge in terms of market cap, is a function of what is going to probably happen in the future. So if you look at the more traditional businesses in the US, their market caps have not gone anywhere. In fact, relatively, they have reduced dramatically. But the newer companies take up larger share of this market cap. So I think that's a hint to where I think the future is. I also don't know exactly where the future lies, but I think that is where the opportunity should be sought.
Well, that's very exciting, Tushar, in the way that you describe it. And yes, it is a huge hint in terms of where we're headed. But I'm interested, and I know you may not speak specifically on a particular stock, but given the big announcements yesterday from Reliance on their new energy foray, It is a sector that's been put right in the middle of, right under the limelight now, given that a major like Reliance is looking at it so seriously going forward. Do you see this, however, deepening into a broader market vis-a-vis just one major player in this space? Because in the past few years, perhaps the timing hasn't been right, but we've had, very selective options when it comes to this segment.
Yeah, I think it's a I would say a blue sky scenario at the moment. We have to kind of rely on how things happen in the next 1 or 2 years. Very difficult to call at this time, but clearly as it gains momentum, there will be other allocators who will definitely start putting up assets in this direction. And I think it is something of a cue to be taken from the world over, where investors are very keen to use the word sustainability. Now, you can argue that these are buzzwords, and as Y2K was a buzzword, but it did engender a huge generation of exporting software companies in India, and actually, we have a huge sector actually which follows that. So something similar can happen here. Who knows? And I think that's something that is always going to be on the horizon. However, this sort of industry does require a huge amount of capital, unlike the software sector earlier, where it did not require physical capital; it required human capital. But who knows? Later on, even the nature of these technologies change to make it more skill-based, and technologies really are based on human interaction. So I think I'm pretty optimistic that this will become a much larger force, and there will be broader participation in this theme rather than just one player.
Tushar, I always look forward to our engagements and interaction. Thank you very much for joining us. Stay safe and hope to see you soon in person.
Absolutely. Thank you.